In this week's episode of the Stockscores Market Minutes, we're going to talk about interest rates and the effect that they have had on the market and whether they will cause further weakness. Plus, I'm going to take a look at the energy sector and answer the question, is it too late to buy energy stocks? And then finally, I'll walk you through a day trade, show you the entry exit points, the stop loss points for a day trade on VERU. All right, so let's get right into this discussion on interest rates. Now, it has been concerns about inflation that have caused interest rates to rise, and that has caused weakness in the stock market for a number of months. I don't know if you would call it a crash, but it's certainly been a significant downdraft for stocks. The question is it over, and will interest rates continue to be the culprit? What I have on screen now is a chart of the inverse ETF for US Treasury bonds. The symbol is TBT, and it represents the 20-year Treasury bond market in the US. When this is going up, interest rates are going up. It's just a simple chart that helps us see that interest rates are rising. And you can see that interest rates began to rise back there 5 months ago, and we continued to get these breakouts and interest rates rose. Now, the initial trend was linear like this, and then it got steeper, and then it got steeper, and it went parabolic. Now, the reason it went parabolic is because there was fear. Because of rising inflation, and it proved not to be so transitory as the US Fed talked about, but instead, that inflation was real, and there was a sudden quick rise in interest rates to try to combat that. Now, this is the US Treasury bond market. It is not to be confused with what the US Federal Reserve does. The bond market tends to predict what the Fed will do. So it has priced in a number of interest rate raises already. And it probably went too high too quickly. When we look at the trend here, how it's gone parabolic, that's an emotional response to fear. And so the bond market went down too much. This is the inverse. So it goes down when this thing goes down when the bond market goes up, and this goes up when the bond market goes down. When the bond market goes down, interest rates go up. I know that's a bit confusing, but that's the way it all works. So you've got a parabolic trend in interest rates, and now it is correcting backwards toward the linear trend line. And you can see that it bounced off of that linear trend line about a week ago, which is likely why we had a little bit of a bump higher in interest rates this past week, and that brought a little bit of instability to the stock market, although stock market seems to be holding in okay. So typically what happens when a trend like this goes parabolic, it usually goes sideways for a while, at least. I don't think it's going to break the upward trend line, so you can see that we've come back to it. We may just bounce along this upward trend line for a little while. And then the question is, do we break down through it or do we break out? If we break out, I think there's going to be a lot more weakness in the stock market. If instead we break down through the upward trend line, then that should bring some stability to stocks. So keep that in mind as we go through some of the other important charts that I want to take you through. So the first important chart we were going to look at is a chart of the S&P ETF. The symbol for that is SPY. So I go to Stockscores, I punch in SPY in the top left, and we're going to start by looking at the very short-term chart. This is the 1 month, and I'm making this a 60-minute chart. So you can see that we had weakness about 2 weeks ago, and then we built this little rising bottom, broke the downward trend line, and now we've been moving up, and this past week, not weak, but relatively stable as interest rates sort of bounced up a little bit. So the question is, are we going to break down through this floor? If so, that would be a negative, of course, and if we break out through this level, then that would be a positive. So looking in the short term, I'm neutral on the S&P and US stocks in general, as it's going in that little sideways range, but it is at a rising bottom, so things looking a little better than they did, say, 2 weeks ago. Now let's take a look at the small cap sector. I like to look at the small cap index, IWM, because it helps me read what retail traders are doing. These are small cap stocks. They tend to be traded more by people at home as opposed to the large institutions which dominate the large cap stocks. And so this is a good gauge of how retail mindset is. And you can see that in general, looking at this daily chart, we're in a downward trend and we're basically bouncing back from being oversold. In the short term, if we look at, say, the last 10 days, you can see that we have been building rising bottoms, and so retail trader confidence has improved a little bit in the last few weeks. Is it good? No, it's still long-term negative, but in the short term, it's getting a little better, and that may improve some of the swing trading and day trading opportunities if you're into that. For the longer-term trader, the position trader, you have to focus on the sectors of the market that are strong, and the strongest sector has been the energy sector. And so we'll take a look at the Canadian Energy ETF. The symbol for that is T.XEG. And here you can see that this market has been in an upward trend. There's our upward trend line. And right now we're quite far above the upward trend line, which means it is likely to pull back in the near term. So I'm often asked, is it too late to buy energy stocks? Well, anytime a market or a sector is well into an upward trend, the only real time to buy those stocks is on pullbacks. So when the market or the stock pulls back to its upward trend line and then bounces off of it, then there's an opportunity. I call that a pullback play. So returning to the chart of the XEG, we had a pullback to the trend line here. We had a pullback to the trend line there. So those days were entry points. It's just a good point to get in and be able to manage risk, because what you do is you put your stop just a little below the pullback, and then if it doesn't work, if the trend is in fact over, then you get stopped out for a small loss. What you do not want to do is be a buyer when you are far above the trend line. Only buy the breaks of pullbacks. And you can see in the last 4 or 5 months, we've had 4 of them, and those are good, reliable places to enter some of these strong stocks. So take this principle and apply it to individual energy stocks, stocks that you may like, and just look to buy them on weakness as long as that long-term upward trend line is not broken. All right, let's move on to the Canadian market, which is really dominated by energy stocks. And so it has performed better than the S&P, better than the IWM, because it has that section of the market that's sort of propping up the rest. So it's a bit of a misleading sector, because when I look at this, I say, okay, generally it's sideways. Well, there's a lot of stocks in the Canadian market that are very weak, but the index is got a heavy weighting of oil and gas stocks, and so that's sort of propping this market up. And so it's kind of a tale of two markets. You've got the energy sector, and then you've got everything else. You've got the gold mining sector as well, which has been okay. It had a bit of a drop 2 months ago, and now it's sort of stable. So you have to sort of trade the Canadian market differently. How you trade a Canadian bank stock might be very different from how you trade a Canadian energy stock. And you got to look at the sectors in the market to see where there is strength. All right, well, let's take a look at how those rising interest rates are affecting the US dollar. There's a pretty strong correlation. You can see the US dollar chart looks very similar to the interest rate chart. It too went parabolic to the upside, and now we've pulled back to the trend line and we're bouncing off of it. So there's a good chance that the US dollar goes up, especially if interest rates continue to creep back higher after that pullback that they had 2 weeks ago. All right, so the last thing I'll take a look at is the cryptocurrency market, GBTC. I know many of you are interested in crypto, so let's just take a look at the Bitcoin ETF. And there you can see we had a little bit of strength this week. We gapped up on, I believe it was Tuesday, but we've given back all the gains. Now, why is that? Well, the problem is when you break up into higher prices, when there are people that own at higher prices, that's essentially pessimism. All of these people, really all of the people that have bought any time in the last 10 months or so, they're losing money. And what do you do when you're losing money? You hope that you can get out at least break even. And so when there's some bit of a pop in something like Bitcoin, the people that own it, who've been losing on it, they sell into the strength. They're trying to get out and just get out without a big loss. And so that's why it's always tricky to buy things that are coming out of downward trends. As long as the dominant trend is intact, you really don't want to be a buyer. So I'm still bearish on Bitcoin. So let's take a look at my ratings then. US stocks, really the same as last week. Bearish long-term, short-term neutral. Canadian stocks neutral on both time frames. Gold, long-term neutral, short-term neutral as well. Oil, still bullish long-term and short-term. It's getting a little overextended in the short term. I think there's a good chance that it will pull back in the near term. US dollar, bullish long-term, but short-term bearish. It has been pulling back the last little while. It'll need to bounce off of that trend line. And then Bitcoin, I'm still bearish long-term. Short-term, it's gotten a little bit better, so I've raised my rating to neutral. All right, now let's take a look at the day trade of the week, and I try to give you an example of some of the things that we day trade on Stockscores in the Stockscores Active Live webinar, which runs every day. And in that, I highlight stocks that are making what we call action candles. It's actually all done by a computer. We've written algorithms to go through the entire US stock market in real time, analyzing essentially 7,000 stocks in real time, looking for stocks that start to behave abnormally, where there's strong buying coming in. And it gives us an edge because we can catch the future hot stocks before most people catch them. And so what we look for with what I call my day trader strategy, I know it's a great original name, is a 2-minute action candle, which you see on chart here as the little pink dots. So anywhere there's a little pink dot, that is called an action candle. And when we get these action candles breaking out of predictive patterns like we did here on VERU, which was breaking from a ascending triangle pattern early in the day on Friday, they often then move into an upward trend. So if we go through the economics of this trade, the entry point, I'll just highlight it in yellow, it's a little easier to see, is there. Your risk, what we define, sorry, I want to make this yellow. So our entry point is there. Our risk management, we use that space there to define our position size. So that, if we're taking $100 of risk, would mean we would buy 430 shares. Our actual stop loss is going to be just below the last inflection point low. And then we, if it doesn't get stopped out, we enjoy the run higher. So in this case, we bought 430 shares for every $100 of risk, which means if you want to take $200 of risk, you buy 860 shares. These concepts are all things that are taught in the Active Trader course on Stockscores. You can learn more about that in the trader training section of stockscores.com. So this trade requires $5,779 of capital. However, if you have a margin account, you can leverage that 3-to-1. So your broker will give you 2/3 of the capital, and that therefore you only have to put up a little over $1,900 to take this trade. Now by the end of the day, it had gone into a nice upward trend. So the question is, when do you sell these things? One of the things I like to do is just draw a simple linear trend line, and if that linear trend line is broken, like it was right there, then you have your exit point. So that occurred at about 5 RR, 5 times risk, which meant a $500 profit for capital required of $1,930. That's a 26% return on a one-day hold. And that's the kind of things that we do in our Active Live service. And of course, I can teach you all of the rules if you are part of the Active Trader membership on Stockscores.com. Hope you've enjoyed this week's analysis. If so, please click on the like button. Leave me a comment. Do you think interest rates will continue to drive the US and global stock markets? And most importantly, as you go into next week, make sure that you trade well.